Hey folks, it's Dave Burrows. I am Chief Strategist and CIO here at Barometer Capital Management. Thanks everybody for joining in today. We're hitting the middle of summer. It's been 3.5 years now since we started doing these weekly webcasts. And of course, the audience has grown over time, which is great. We're getting lots of views, lots of questions, and I really appreciate that. We started this to make sure that we were communicating effectively with our clients so that they could really understand how we were seeing the world in what was at the time a very quickly changing world, and what that meant for portfolios, making sure that we were staying aligned with what was actually going on in the world. And so on a week by week basis, what I try to do is take a big picture, top down view of the world, talk about what's changing, talk about what that means for our portfolios, and to try and be really transparent about what drives our decision making. I think that that's something that is lost in some ways in the world of investment management. We are active. We try not to look like the index, and we'll talk a little bit about that today. But the indexes play a big part, so we want to understand what's going on there. The sector work plays a big part, so we want to understand what's going on there. And so with that, why don't I kick off? We believe we started a structural bull market for stocks in 2013 in the US. Over time, other markets have joined the rally. The rally has broadened. We've had lots of ups and downs. If you take the period from 13 to present, there have been 4 significant corrections along the way, not the least of which was the sell-off headed into COVID. But in general, in a structural bull market, you wind up lower bound by the rising 200-week moving average, which was the case all the way through the 80s and 90s. But you still had significant corrections in both time and price. A most recent major correction ran from December of 2021 through until January of 2024, so 25 months. It's about 25% in depth. And we said through that piece that we thought ultimately that October of 22 was the low, and that ultimately, once we made a new high, we were likely to get an extended period of relatively low volatility and solid returns, which certainly was the case through the 80s and 90s and between these corrections, and certainly has been the case since 2013. And here we are now, about 6 months since we made the first new high in the S&P, and the market has continued to broaden. More sectors participating, more companies participating. Doesn't mean there haven't been wobbles along the way. When we look at the S&P over that period, this was the most recent low in October. Market rallied sharply until April. We had about a 5% correction in April. Our breadth indicators, which we follow, which track the percentage of securities that are trading with positive long-term trend, turned positive and has been positive really since then. You can see that there has been another roughly 5% pullback, 4.9% in the S&P, back to the 50-day moving average. This has been really different than other corrections that we've had, because during this period, while the largest of large cap stocks corrected, the average stock really accelerated. So there has been a significant rotation in the market. When we look at the equally weighted S&P, while it underperformed for a period of time, it absolutely blasted off on the 11th of July and has been working its way higher since. We're just below the recent highs. To put it in context, the Russell 2000, which really has been a star over the last couple of weeks, broke out of a 2-year base. Since that happened, the Russell 2000 has gained just about 15% on a relative basis versus the S&P. And if we look at it versus the NASDAQ's down about 10% off the highs, NASDAQ 100. And of course, Russell 2000's up 14%. So not insignificant. That's a very important rotation. We talked about some of the statistics around this over the last couple of weeks. But historically speaking, when you got this kind of significant outperformance, it wasn't a fluke. It wasn't just short covering. It was a significant change in the nature of the market. And we have to recognize these changes and make sure that we keep our portfolios relevant. Now, over the last year, while the S&P that is cap weighted or weighted to the biggest companies had significantly outperformed for a long period of time. We highlighted the fact that over time, actually in more years than not, the equally weighted S&P has outperformed the cap weighted S&P. So this is an important statistic because we need to understand what can happen. Part of our job, and I started doing this in 1986, is to understand market history and understand the things that can happen, because the most recent things that have happened don't necessarily just continue. And we've had a couple of years where there've been real significant outperformance of the largest companies, probably the most significant since the very late 1990s coming into 2000. The differential in valuations has been significant. And so realistically, it's something that we just want to be aware of. We don't know what's going to happen, but we want to understand what can happen. So outside of the US, we know there's been strength in a number of global markets. Nikkei 225 has been particularly strong and has been a favorite target for Warren Buffett. The India market has performed really, really well after many, many years of underperforming. It's just been on rails. We've had pretty good performance in parts of Asia. Taiwan, in particular, though, it pulled back a little over the last couple of weeks on the back of some weaker semiconductor numbers. But the TSX, interestingly enough, in our local market, has really been a strong performer over the course of the year. And I put this big picture up because this is 2008. This is 2021. It's a long time to go sideways. Eventually broke out in 2021 and consolidated during the sort of global tightening cycle. But over the last few months, these are monthly bars, has broken out to new highs. And so TSX is up about 5-6% over the last 30 days, well outperforming the large US indices. Partly that has to do with sector weights, and that's part of the reason some of these global markets are performing well too. So that's a shift we recognize, and we are trying to take advantage of global markets alongside the Canadian market. We have probably more Canadian exposure than we've had in a while, and we have been focusing on some positions that aren't just the largest companies, because there's been some good returns to be had there. So we'll talk a little bit more about that as we go. As for fixed income, we think we saw generational low in interest rates in 2020, not too dissimilar from what happened in the late 1940s. We think that we have shifted the long-term trend in rates to higher. Although recently, this has moderated a little bit. It may be in the short run rates come in a little, but this was a significant trend change, and it means that we go from 40 years where the borrower was in control with falling interest rates and cost of capital to probably the next 25 or 30 years where the lender is in control, and where we see sort of higher highs and higher lows in rates, which has an impact on what may do well in the market. When we look at the long end of the US Treasury market, from 2020 to the low point was down about 53%. Rates have come off a little bit, still down 48% from the highs. So you've had your coupon, but you certainly haven't had any capital growth. You've had some capital contraction, and that's been a conundrum for income investors. Now, while most private investors have been pretty patient with their fixed income, and as most people know, we have not been a fan of fixed income now for 3-4 years. Big global players are losing their interest. The Chinese have been big sellers of US Treasury bonds. We think that the Japanese are in the process of reducing their Treasury bonds, which is an issue because these people have been the largest purchasers of Treasuries, helping to fuel the deficit in the US. So something to keep an eye on. For our income investors, we've been more interested in equities versus bonds. We can see that the SPY versus the aggregate bond index has been steadily outperforming since 2020. And in particular, we've really liked dividend growth stocks. So I compare here the RDVY Dividend Growth ETF versus the aggregate bond index. And you can see very clearly, even sort of through the bear market of 2022-23, they did about the same as fixed income. But since we saw low in the market, April of 23, dividend growth has steadily been outperforming it again this week. So this is really important. Now, as I mentioned, since July the 11th, there has been a big acceleration or increase in participation in small and mid-sized companies. And that's not lost on dividend growth stocks from mid-sized companies. The SDVY, Small Cap Dividend Growers ETF, also is outperforming and has had a very good couple of weeks. So this is sort of more validation for the fact that we're focusing on dividend growth. Our income strategy really can go anywhere. We can be in fixed income, we can be in preferred shares, we can be in dividend paying common shares, we can be in dividend growth stocks. But we want to focus on the things that can be revalued best. Last time we saw this shift in interest rates in the late 1940s, strangely enough, while rates went higher for the next 15 years, bonds went up 1.6% a year, inflation was 1.6, and stocks went up 15% a year. So equities were the way you offset a rising cost of living. The best performing stocks over that period of time were the companies that had the greatest ability to grow their dividends. Companies that generated excess cash, didn't need debt, didn't matter what rates were doing because they were generating more cash than they needed and they paid it out to their stakeholders. So in our income strategy, we can go anywhere. But what I think is most unique about this strategy is since we started running it in 2000, if I highlight each of the periods in gray where rates were rising on a 10-year treasury, typically that's a tough time to make money for income investors. But we can see that in every one of those periods, the income mandate had significant excess return over fixed income. Now, we think this is the world we're going to be in for 15 or 20 years with interruptions. And this kind of differential, I think, is really, really important. So how do we do that? Well, I was talking to Jim Skatakis this morning. I got him to put this together. He was highlighting the fact that if we take our portfolio, which actually looks very unlike that dividend growth portfolio, and look at sort of some characteristics, well, our dividend yields above what the index's yield is. The price earnings multiple significant discount to the index. And then if you look at the dividend growth rates, the 5-year dividend growth rate at 13% versus 9, the 3-year dividend growth rate at 14 versus 10, and the 1-year dividend growth rate at 29% versus 14% for the index. If we look at it another way, how different than the index do we look? If you put a scale from 1 to 10, where 1 is acting just like the index, or 100 is acting completely differently than the index, you can see that the active share across our portfolio is very high, meaning that it's really a lot about positioning, sector positioning, and security positioning that makes a difference. And from 2000 through 2024, it resulted in just about a doubling of our benchmark, which is 50% the TSX Equity Income Index, 50% the Canada Equity Index, and then, 50% the Broad Bond Index. So we think that there's a real opportunity here. Dividend growth helps offset a rising cost of living. So what else does well in a more inflationary environment? Of course, commodities do. And so when we were in a disinflationary world, commodity prices fell. This is the United States Commodity Index. It started to rise when rates started to rise, consolidated during the period where rates were rising, and is now lifted out of that range. And we can see a series of higher highs and higher lows on the point figure chart for this commodities index. Now, one of the topical areas I think right now is gold. And it is a pretty universally hated asset after going from 2011 through 2021 without really making money. But over the last number of months has sort of blasted off. Now, what's strange about this is it looks very uncannily like the last bear market that took off in 2005. And from 2005 to 2011, gold went up 350%. So these assets are cyclical by nature. They have their day in the sun, and then they go out of favor for long periods of time, which means over ownership gets washed out into the market. People give up on them. But when we see this happening, this is something we think is significant. Now, seasonally, we're into a strong period of time for gold, which that's one thing. It's a short-term issue. But interesting enough, despite the fact it's performing well, look at what's happening with the ETF holdings of gold. Private investors are poo-pooing it. And that's actually, to me, really bullish. On the other side, over the last number of years, we've had a very significant pickup in buying by central banks around the world. So where is the smart money? We'll see. But central banks have big checkbooks. They're looking for alternative assets to, say, U.S. Treasury bonds. We are looking for alternative assets to Treasury bonds. One risk in inflation, in disinflation, is that prices drop and you lose your money. Risk in inflation is that inflation eats your money, and so you need things to offset inflation. Gold can be one of those things. Now, I'm not going to make any assumptions here, but I just want to put this chart up. This is a chart that plots gold versus the NASDAQ. Now, we'll see how this develops. But the last time you got a reversal, meaning NASDAQ was outperforming gold, gold broke out and traded down along that downtrend and then eventually got going. And then it went up on a relative basis from 2000 through 2010, where it broke down and then traveled up along the underside of the trend line and retested it and failed and reversed. And then we were in a downtrend. So this was NASDAQ outperforming gold for over a decade. It reversed in 2022, traded down along the trend line, and looks to me like it's trying to reverse up here. So we'll see. It's probably not a very popular view, but it's possible we're seeing a significant reversal in assets that do well in a disinflationary world, where rates are generally lower and you can pay for future earnings, to a world where maybe inflation is a little higher and you need to own sort of inflationary assets. So we'll see. Moving on, we're into earnings period, and we talked about this over the last couple of weeks. Earnings started to contract in 2021, and they actually went negative in the fourth quarter of 22. Stock market was looking out in the future and rolled over in the fourth quarter of 21, went through a long bear market. We've seen some relative improvement in earnings. Q2, it looks like we're going to get 9% earnings growth. But interestingly, when we look at the trajectory of earnings revisions, typically through the quarter, you get quite significant reductions in earnings estimates. That's a historical trend. In Q1, we had less revisions to the downside. In Q2, significantly less revisions to the downside, which means it's likely that we probably outperform going through earnings period. Now, everything doesn't act the same, but something I think is interesting. The Magnificent Seven obviously have been big contributors to earnings, which is why they were leading the market. This will be the first quarter where the other 493 earnings will turn positive. Perhaps that's why we're seeing a broadening out in the market. We'll see. But in my view, it's a healthier market when there's broader participation. It means more money's getting put to work. It's a healthy market. So from our point of view, we take a tactical approach. The whole purpose of this webcast is to say, first of all, where is the market leadership? Which sectors and themes are in a position to be revalued, and where we can see they are being revalued? Where is the wind at the market's back? Let's focus in those areas. Let's watch for change in leadership, old leadership to recede and new leadership to emerge, so that we can make sure we're balancing the portfolios to what's working. And in the absence of leadership, we're very willing to sit on cash or be out of big parts of the market. So our portfolios generally look very unlike the market. We try and take advantage of market strength where we can find it. And when there isn't strength, play defense, making sure little mistakes don't turn into big ones. Now, I saw this quote this week and I smiled, because I've said this through multiple years of these presentations. We have found that a major source of return is getting the market right and getting your sector weights right. And I've generally quoted between 70 and 80%. This was a quote from Stanley Druckenmiller, who many may know as one of the most successful hedge managers in history. He's the one who broke the Bank of England on the British pound. People always forget that 50% of a stock's move is the overall market, 30% is the industry, maybe 20% from stock picking. We suffer sometimes hearing people focus just solely on the stocks that they own, and say, well, the market will take care of itself. Well, we know in 2008, the market didn't take care of itself. And we know that in 1974, the market didn't take care of itself. Didn't matter what you owned, you got hurt. So we have to recognize change in markets. In our process, we believe a big part of return comes from getting the market and sectors right. Where is it we have the wind at our back? And then let's find securities we can use to take advantage of those themes. So in my work, I focus on understanding the macro environment. What is it? Where of all of the areas we could focus, stocks, bonds, commodities, currencies, real estate, what is it that is performing well and behaving well? When I say behaving well, in a neighborhood that is seeing net inflows of capital, you should see more and more securities participating in strength. If over time fewer and fewer companies are performing well, it means there's not enough money coming in, or there's enough money leaving where the risk reward levels have changed. So I run breadth models that help us to recognize where breadth is improving, where more and more stocks are doing well, and we focus our attention on those areas. Our bottom-up team, which is, does a lot of significant due diligence work, are aiming to find companies that are good getting better. We're always running a farm team of companies that we would like to own if it happens to be that the group or sector that they're focused in starts to perform well. We're looking for companies with strong balance sheets and income statements where something is accelerating and improving. And we want to see price doing what it should be doing given what we think we know, technically and fundamentally sound. We can find areas of the market that see net inflows and securities that are meeting and exceeding expectations. That's where our portfolio should live. Now, that's a living, breathing thing, and positions will stay in there generally as long as they work, as long as they continue to meet our expectations. But we have to be really disciplined on the sell side because the hardest part of investing is knowing when to sell. As I say, it's very important you don't let a little mistake turn into a big one. You don't fall in love with your securities. From a market perspective, we're looking for areas of the market that see more and more companies participating in strength. That's healthy. There's no bear market ever took place while that was happening. When we see deterioration in breadth, we take notice because even if our stocks are performing well, if fewer and fewer are carrying the day, it means that money's leaving. Okay, so this is an important concept. So when we talk about leadership, about 6 weeks ago, we were in a position where the percentage of stocks in uptrends had been deteriorating. We saw fewer stocks trading above their 50-day moving averages around the world. We saw fewer stocks trading with positive weekly momentum or upward trajectory. We were seeing fewer new highs and new lows. And we were seeing stocks break below their 150-day moving average. Not all stocks, but some areas. Here's where we sit today. It's a markedly better picture. And forgetting about just the largest stocks, we've seen broadening into mid-cap companies and small-cap companies. Interesting, despite the fact that the S&P was down about 5% off the highs and the NASDAQ down 10, actually the percent of stocks in uptrends over the last 2 weeks is up. The percent of stocks trading with their 50-day moving average is up. And look at the highs versus lows. These are really important readings. It tells you that under the surface, there is tremendous health in this market. So let's look at the leadership groups. Our most important group currently and for last number of months is financials. Now, this is an important sector. The reason we're here is because it went from 2007 through 2021 without making a new high. Over that time, anybody who was unhappy had an opportunity to sell their positions, and many did. Eventually, in 2021, the sector broke out, and then we went into this global tightening cycle. Look at the last 10 months for financials. They have just marched higher, up almost 7% just in the month of July. Now, groups made up of a bunch of different securities, made up of financial technologies, made up of banks, made up of insurance companies. This is the bank's ETF, KBE. Now, this is the large bank, so it includes companies like Bank of America and Citigroup and JP Morgan, which we've talked about many times. But coming into earnings, they aren't showing any sign of stress. Sorry, this is the insurance ETF. I'm sorry, KIE. So last few weeks, charging higher, trading above all the moving averages. Manulife has been a favorite position of ours. We've talked a little bit about Reinsurance Group of America. We've talked about Progressive. We've talked about Fairfax. All these companies are trading basically at their highs. Fairfax reports in 2 days. RGA reports in 2 days. We're going to get the report cards, but I really like the way they're trading going in. And you can see the strong ramping relative strength versus the market. In the banks, we're seeing companies like Imperial, CIBC here in Canada make new highs, Royal Bank, JP Morgan in the US, Citigroup, the list goes on, Goldman Sachs we've talked about. I think this is a great barometer for the health of the market. These are companies that benefit the environment that we're in. We're likely to see great dividend growth. We're likely to see good share buybacks. They're well capitalized. They don't need to raise debt. These are companies that are well suited to this environment. And as I said, the future likely belongs to the lender in a world of rising interest rates. TMX Group in the world of exchanges continues to march to new highs. So financial services, check. The group looks strong. Move to industrials. Industrials have led since before the market bottomed in 2022. In fact, they bottomed about 5 months before the market did. This is an equally weighted basket of industrials. We've talked about the relative strength of equal weight industrials versus the equally weighted S&P, been pretty steadily higher. We've talked about defense quite a lot. Boy, a big day today for defense stocks, and a really big day for likely what is our biggest position in this area, and this is Howmet Aerospace. Now, I was going to have Jim Skatakis on today, and I don't see him in my waiting room. So I'm going to have to jump in on it on my own. Howmet beat on almost every metric today. You can see the stock was up 12%, behaving extremely well. They've been winning across all of their verticals. The estimate for this year is for 30% earnings growth, 21% earnings growth next year. But look at the relative strength has just steadily ramped. What I in particular like technically is it's been a very, very smooth ride along the way, relatively little amount of volatility, and they have been beating regularly on the quarter, and look at the response we're getting. So very, very pleased with that. Moving on, mid-cap industrial companies that are selling into the reshoring of manufacturing continue to behave well. This ETF, AIRR, better than 88% of the companies in the S&P. We have Crane Corporation, which reported strong numbers today. Owens Corning, which reported strong numbers today. We have the engineering companies, which we've talked about. This has continued to be very strong. Again, good indication for the U.S. economy. Technology. Technology has been a little bit more problematic. Of course, very, very strong from the beginning of the bull market early in 22. Had a period in the early winter where relative performance was weak. We rallied again into spring, and you can see the rollover in relative strength. So the XLK ETF is down about 10% off the highs. It's relevant because it is populated by the biggest of the large cap tech stocks. We have had positions here. We've talked over the last number of months how we had reduced well below index weight. We came into, I think last week, about 11% of the portfolio in tech versus 28 for the S&P. We talked last week about what was going on in semiconductors and in the group. Now, just from a flows perspective, flows have been into tech, for a long time. Over the last few weeks, we've seen flows into the non-tech sectors, and that has, to us, meant there's some rotation. When I look at breadth, or the percent of stocks in uptrends, this is bullish percent for the NASDAQ 100. We got a percentage reading on the x-axis, and you can see that since the beginning of July, this was as of last week, we had gone from 62% of stocks in uptrends to 52%, and it was weakening. So when it's weakening, we become more cautious. When we looked at the semiconductor group, when we look at NASDAQ bullish percent this week, we've moved down from 50 to 44. So now 44 out of 100 stocks in uptrends, that's narrowing breadth. It continued. When we look at the semiconductor sector in particular, we've gone from 60% of stocks in uptrends in July to 26% today. These are point and figure breakdowns, reversals in trend. we have to take notice. About 4 weeks ago, we highlighted that semiconductors have a tendency to get stretched well above the 200-day moving average. And when they do, at some point, you tend to either correct sideways in time or downward in price. Now, I don't know what it's going to be, but we got 70%, 78% above the moving average. We've had 3 down weeks in a row now. Maybe we have price correction. Maybe this is a short-term issue, but we have to take note. In the case of NVIDIA, which we have let small pieces go along the way on the way up, got to a point where it's 340% above the 200-day moving average. Now, if I had James Callahan here in front of me now, he'd say, look, this is a great company, and their earnings growth is dynamite, and they're likely to report a very good earnings report this quarter. But a stock is a stock. And when things get really, really extended and start to show reversals on high volume, we have to take note. So we sold, as I mentioned a week ago, we sold about a third of our position that was remaining. It may be that we were stopped on some more today. I don't know. I didn't see it this afternoon. But certainly, you know, that the stock is down about 26% off the highs as we sit now. I think that Microsoft has reported it looks like it's trading down a little bit. The tech stocks are going to take a cue off of that. So our weight in the group has sort of continued to come down. This was sort of where we were a week ago. This is where we are today. We're still a fair ways above the 200-day, which will be down at $80, which I'm not prepared to trade down to. Qualcomm, we also got stopped out of. A great position while we owned it, but at some point you have to be prepared to step aside. So there's change taking place at the market level. Outside of tech, materials continue to, I think, look quite attractive. We're 5 months higher off the lows from the spring. We've come out of a period where we were getting global tightening. The gold stocks, you know, behaving really, really well. So that conversation, NASDAQ versus gold, is actually a really relevant one. It's not a popular one, believe me. Kinross is trading now better than 92% of companies in the S&P over the last 52 weeks and has been on rail since February. Agnico Eagle basically closed out close to a high, better than 90% of stocks in the S&P over the last number of months. Again, not very popular, but these are companies that are generating a lot of cash. They trade at very reasonable multiples. The dividends are growing. Agnico grew its dividend this year 33%. I think that these are quite attractive, and it's interesting that some of these value sectors have started to act better. Also for materials, it's relevant that home builders have really perked up. This is probably the strongest ETF on the board over the last 2 weeks. Home builders and home building materials and infrastructure, both of them use materials. So Vulcan Materials, which is aggregates, trading better than 75% of companies in the S&P. Owens Corning, that makes roof shingles and insulation, trading better than 86% of companies, are basically at the highs. No sign of NASDAQ weakness in these companies. So I do think that there is rotation taking place. Today, there was an announcement that BHP and Lundin Mining were bidding for Philo Mining. This is a $4 billion copper development company. There are other places that we can make money. When it comes to energy, energy looks like it's building a very good base to go higher. We've been focused on the large cash flow generators. The XLE put in a new point figure buy on its point figure chart. That's the broad-based energy ETF. The XOP, which is the energy producers ETF, also gave a point figure buy signal. And when we look at Imperial Oil, one of our biggest positions, pays a great yield. It's been growing its dividend over 20%. And I thought this was really interesting. From 2019 to today, they've taken their share count down from 750 million shares to just over 500 million shares due to buybacks. So these big oil companies are returning a lot of capital to shareholders, and I think that they can probably move a lot higher. Recent strength in utilities is continuing. Our move into Southern Company behaving quite well. This, of course, is partly being driven by growth in demand for data centers. The real estate investment trust sector is showing some improvement. We don't have a big weight here, but we did put an initial position on a few weeks ago in Simon Properties and a real estate ETF in our macro fund. And this is a shift relative to the S&P over the last couple of years. Real estate was very weak. It is showing some improvement. That's probably a bet that the short-term rates come a little lower. I think this is the biggest story. Small cap stocks. The blast off in small caps out of a 2-year-long sideways consolidation, I think, is relevant. If this was just short covering, it would have lasted 2 to 3 days. But the fact that we've had this significant outperformance over the last 12 or 14 days is important to recognize. We believe in finding companies that are good getting better in parts of the market that have been out of favor. We like to find companies that are performing well before the market makes a turn, because the ones that were performing well before the market makes a turn generally are the ones that continue to lead. The XMMO is a mid-cap ETF made up of mid-cap momentum companies. The list in this ETF is worth taking a look at. We've talked about some of the mid-cap stocks that we're in, like Howmet, like Crane, like Owens Corning, like BWX Technologies in the nuclear power area. All of them meet these tests. So when we bundle it all up, we don't look very different than we did last week. Now, I'll apologize. James Callahan, who puts this chart together for me, is away this week. The only shift I can tell you from last week to this week is that technology has come down further as we exited Qualcomm and as we exited a part of our NVIDIA position. Our financials weight is growing a little bit. Our industrial weight grew a little bit. And the defensive sectors still are a very small part of the portfolio because we don't see any sign of weakness in the market. The reason that we think the TSX looks interesting is that the weightings in energy are more significant than the S&P, financials more significant, industrials more significant, and materials, 4 groups that we think are behaving well. So we've spent a lot of time working through the list of companies in Canada. Not all of them levered to the Canadian market, many of them levered globally, but nonetheless, we think that the sectors make the TSX attractive. Volatility remains bound at a lower level, credit spreads remain friendly, and we can't forget that we've entered into a liquidity cycle where we are now seeing interest rate cuts around the world, not increases. So we're in the middle of summer. We're in the middle of earnings. I think we'll all be interested to see how tech handles Microsoft's earnings. It looks like they missed a little bit, trading a little lower. AMD looks like numbers were pretty good. It's trading a little higher. We'll see how those conference calls go. But broadly speaking, when more and more sectors participate, and when more and more sized companies participate, that's healthy. That means the market's got a built-in shock absorber. It means we can get diversification in portfolios, and we don't have to be overly concentrated. I do think there are people who are very, very concentrated in a very small number of stocks, and we know that that sometimes doesn't end very well. So we'll see. If things get more difficult, we're certainly happy to get defensive. But as it is, I'm feeling okay in the end of July here. We certainly have an election to look forward to, and a lot of the shenanigans that go on around that. But I think the market seems as though it's on a decent footing to deal with the news as it comes. So with that, let me check and see if we've got any questions this week. Anonymous. He liked the presentation. You and I are not buying NVIDIA chips. The Magnificent Seven have been the primary buyers. So how can NVIDIA go from 3 trillion to 6 trillion in market cap when considered the Cisco Systems 650 billion market cap in 2000? Today's under 200 billion. Look, there seems to be an almost unlimited amount of money available to buy these chips to set up and train the systems that we're going to use to create some value using AI. The one question that we have is we don't know what those killer apps are going to be as to how we're going to use AI, but there is a build that has to take place. I don't doubt that big things are going to come out of AI. The question is whether the market's gotten ahead of itself. And I think only time is going to tell that. We have to use technical tools to help us recognize that. And we'll certainly look at the earnings as they come. Everybody will have bated breath when NVIDIA reports. It's something that we'll watch. We will likely have a much smaller position than we did 3 months ago when that happens. And listen, if they can beat and exceed and impress the market and technically things can get firmed up, I have no problem buying companies back that show me that they are behaving the way they should, given what we think we know. But we also have to be able to manage incremental news, and that's why we trimmed our position. From John, missed the Barometer Holdings report over the last 2 weeks. Please summarize positions we were stopped out of. Really, from a additions perspective, not a lot of additions. Our positions have held in pretty well. We did, as we've mentioned, reduce our tech weight, in particular semiconductors. We reduced communications a little bit, but there hasn't been a lot of change. Our portfolios have held in really, really well, and are performing well. So we send our holdings out weekly. If John, if you don't get them by email, just please reach out. For those that like to see the holdings that we have in the pools and funds that we run, please join our subscriber list. We do send out our holdings regularly. We're very transparent about that. Last question. Every time I turn on BNN, I hear about the upcoming recession. You sound quite positive. Can you reconcile? Well, actually, I was looking at a chart today, and I can't probably pull it up fast enough, but when you look at how the market is factoring this, the market right now sees a 33% chance of a recession in the next 12 months. That is down sharply over the last number of months. So that's market consensus. Now, what is consensus? You know, that's the roll up of everybody's views. Goldman Sachs sees a lower chance of recession than that. Morgan Stanley slightly higher. But I would say this, given the earnings progression that we're seeing, improvement, and revisions that are above trend, I would say it is unlikely. When we look at the employment picture, in general, it has been pretty resilient. And GDP has been fairly resilient. So I like to use the market as an indicator. You know, we're not going to be the first ones that figure out that there's a problem. So we have to watch the sensitive groups, the ones that would get hurt if we saw a recession. And financials are a big one. And with capital markets, banks hitting new all-time highs, pretty hard to guess that there's a recession coming. And I think that we'll see indication in the market, in the breadth of the market, the number of sectors that are performing well, and the nature of the leadership, if there is a shift in that view. So I get it that people look at the inversion of the yield curve and say, well, there should be a recession. But, you know, if possible, the market is, sorry, the economy and certain parts of the economy that we're focused in have secular trends behind them and are very resilient. So tune in each week and we'll revisit that question. We're very willing to make change if we see change in evidence. But I would say overwhelmingly over the last few weeks, the evidence is the market is getting stronger, not weaker. So with that, I don't see any other questions. I really appreciate everybody tuning in. If you have a question that you're too shy to ask, give us a call. You know, we're working at growing our business. We take care of about 200 families. We do our best to manage the money in a very systematic way. And if you'd like to have a conversation about that, please reach out. Follow us on Twitter. We put up a lot of content over the course of the week. And absent that, hopefully we'll see you back here next Tuesday. Thanks very much, folks. Have a great week.